There is a number on your mortgage statement. Most people look at it and see a remaining balance. I want you to look at it differently. I want you to see a threshold, a specific threshold, past which every extra dollar you put toward that mortgage is doing less and less work for you. And in many cases, past which you would be measurably better off sending that money somewhere else entirely. That threshold has a name in financial planning. It is called the 60% loan-to-value point. And today, I am going to show you exactly what it is, how to calculate yours, and what to do the moment you cross it. Because the math changes at that point, and most people never notice. My name is Donald Cash. Double chin, gold tie, Jerome, who is currently on the kitchen floor in what I can only describe as a full commitment to horizontal living. I paid off a car loan early once. My financial advisor told me I was making a mathematical mistake. He was right. I slept better anyway. Today I want to talk about mortgages, specifically about the exact balance where paying extra stops being the smartest use of your money. This is practical, specific, and has real dollar implications for most homeowners. Let us run the numbers. First, let me explain what loan-to-value means, because everything in this video flows from this concept. Loan-to-value, or LTV, is a ratio, your current mortgage balance divided by your home's current value, expressed as a percentage. You owe $200,000 on a home worth $300,000. LTV, 200 divided by 300 equals 66.7%. Simple, but the implications of where you are on that scale are not simple at all. Here is the full picture of what changes at different LTV levels and why they matter. LTV above 80%, the danger zone for homeowners who put less than 20% down. If you bought a home with less than 20% down on a conventional mortgage, you are paying PMI. Private mortgage insurance, a monthly fee that protects the lender, not you, against the risk of default. PMI costs typically range from 0.3 to 2% of your loan balance annually, depending on your credit score and loan size. On a $350,000 loan, 0.5% PMI is $1,750 per year, $146 per month. Every month, gone, to an insurance company that is protecting your lender. You receive no benefit from PMI. You pay it until you no longer have to. And here is the rule. You can request PMI cancellation when your LTV reaches 80%. Your lender must cancel it automatically when your LTV reaches 78%, based on the original value, if you have been making payments on schedule. This means, if you are above 80% LTV and paying PMI, every extra dollar you put toward principal is doing something genuinely valuable. It is eliminating a monthly fee that provides you nothing. Getting from, say, 85% LTV to 80% LTV on a $350,000 home requires paying down the balance by approximately $17,500, relative to PMI savings of $1,750 per year. That is a 10-year payback period before you account for compounding. Reasonable. But the calculus changes dramatically once PMI is gone. LTV between 80 and 60%, the transition zone. Once PMI is removed at 80%, the dynamics change. At this stage, your mortgage interest is still relatively high because your balance is still relatively high. If you have a higher interest rate, say 6 to 7%, from a 2022 to 2026 origination, every dollar of principal reduction is effectively earning you a guaranteed 6 to 7% return. Here is the key comparison. A guaranteed 6 to 7% return from paying down your mortgage versus the expected return from investing that money. A diversified dividend ETF like SCHD or VYM has historically returned approximately 8 to 10% annually, including dividends. A REIT ETF like VNQ has returned approximately 10% annualized over the past 3 years. At a 6% mortgage rate, paying extra principal guarantees 6%, investing in dividend ETFs historically returns 8 to 10%. Math slightly favors investing. At a 7% mortgage rate, paying extra principal guarantees 7%. Investing in dividend ETFs historically returns 8 to 10%. Math still slightly favors investing, but the margin is narrower. Psychologically, many people prefer the guaranteed return. This is the zone where the decision is genuinely personal. Both choices are defensible, and a personal preference for financial security over expected return optimization is completely rational. There is no objectively correct answer between 70 and 80% LTV for someone with a 6 to 7% rate. It depends on your risk tolerance, your psychological relationship with debt, and how close you are to retirement. Now, the 60% threshold and why it matters differently. LTV below 60%, the optimization zone. Here is what changes at 60% LTV. 1. Your home equity is substantial. You own 40% of the value outright. In a housing market downturn of 20 or 30%, you are still above water. The risk of negative equity is essentially eliminated. 2. The interest you are paying is now on a much smaller balance. The compounding effect of extra payments is diminished because the balance is lower. Let me show you the math concretely. Take a $400,000 home with a $300,000 original mortgage at 6.5%, 30-year term. Standard monthly payment of approximately $1,896. At the beginning of the loan, if you pay an extra $500 per month toward principal, you would save approximately $127,000 in total interest and cut the loan term by approximately 10 years. Extraordinary impact. Every dollar of extra payment early in a mortgage has enormous leverage on total interest paid. Now, that same mortgage, 12 to 15 years in, your balance is now approximately $192,000. You have crossed the 60% LTV threshold. You still have a 6.5% interest rate. An extra $500 per month still saves you interest. But now, the balance is lower, the remaining term is shorter, and the total interest saved by that $500 per month is perhaps $30,000 to $40,000 over the remaining life of the loan. Meaningful. But compare it to an alternative. That same $500 per month invested in a dividend ETF at 8% annual return for the remaining term of the mortgage becomes approximately $90,000 to $100,000. Plus, it generates passive income along the way. The math has shifted. Paying down the mortgage still works, but investing the excess often works more. This is why 60% LTV is the inflection point. Below it, the opportunity cost of extra mortgage payments starts to outweigh the guaranteed interest savings. For many homeowners, it is the rational moment to redirect surplus cash from mortgage paydown to investment. Now, I want to address the psychological dimension, because finance is not purely mathematical. Paying off debt feels good. It feels like progress. It feels like security. These feelings are real and they matter. There is genuine value in owning your home outright, or in being on a clear trajectory to do so. The peace of mind that comes from low or no housing debt is real and cannot be fully captured in a spreadsheet. I am not dismissing this. What I am saying is, past 60% LTV, the pure mathematical case for accelerating mortgage paydown weakens. The case for investing surplus cash strengthens. And if you can separate the math from the emotion clearly, you can make a more informed decision. Some people will run the numbers, see that investing outperforms mortgage paydown, and still choose to pay down the mortgage because the security matters more than the optimization. That is a completely valid financial decision. Some people will run the numbers and redirect surplus cash to dividend ETFs because the expected return differential matters more to them than the debt reduction. That is also a completely valid financial decision. What is not valid is not running the numbers at all, not knowing where you are on the LTV scale, not understanding what is changing and when. Let me now give you the specific steps to apply this in your own situation. Step 1. Calculate your current LTV. Get your most recent mortgage statement. Find the current principal balance. Estimate your home's current value. You can use Zillow or Redfin as a rough estimate. For a more accurate number, request a comparative market analysis from a local real estate agent, which is typically free. Divide the balance by the current value. Multiply by 100. That is your current LTV percentage. Step 2. Identify which zone you are in. Above 80% and paying PMI, every extra dollar toward principal is working hard. PMI elimination is a clear and high return goal. Focus here first. Between 60 and 80%, the decision is genuinely personal. Both paying extra and investing are defensible. Factor in your interest rate, your risk tolerance, and your retirement timeline. Below 60%. This is the zone where redirecting surplus cash from mortgage paydown to income-generating investments makes the strongest mathematical case, not a certainty, not a mandate, but the strongest case. Step 3. If you are above 80% LTV and paying PMI, check whether you are eligible to request cancellation now. You can request PMI cancellation in writing once your LTV reaches 80%. Your lender must cancel it automatically at 78% based on scheduled payments. But here is what most people do not know. If your home has appreciated significantly, you may already be at 80% LTV, even without making extra payments. You can request cancellation based on current appraised value with a professional appraisal, which typically costs $400 to $700. If your home has appreciated enough, a $700 appraisal could immediately eliminate $140 or $200 per month in PMI. That is a 3 to 4 month payback period. Almost always worth it. Step 4. If you are below 60% LTV and have surplus cash, consider whether your money is working harder, paying down a 5 to 7% mortgage, or invested in dividend ETFs, historically returning 8 to 10%. If your mortgage rate is 5% or below, the math strongly favors investing surplus cash over accelerated paydown. A 5% guaranteed return is available elsewhere with comparable or lower risk. If your mortgage rate is 6 to 7%, the decision is close. Both choices are defensible. Consider splitting, some toward mortgage paydown, some toward investing. The diversification of decision reduces regret risk in either direction. If your mortgage rate is above 7%, paying down the mortgage has a more compelling mathematical case. A guaranteed 7 to 8% return is increasingly difficult to beat on a risk-adjusted basis. Let me address one more scenario that is increasingly common in 2026. Homeowners who bought or refinanced in 2020 to 2021 at 2 to 3% rates. If you have a 3% mortgage, paying it down is one of the worst financial decisions you can make. A guaranteed 3% return from paying down that mortgage is available in a high-yield savings account, the same 3% with complete liquidity, no prepayment, and it is available at potentially 8 to 10% in a diversified dividend ETF. If you have a 3% mortgage and you are making extra principal payments, please stop. Take that extra payment. Put it in a high-yield savings account at 4.5% if you want no risk, or in VNQ or SCHD if you can tolerate some. Either way, you are earning more than 3% with comparable or manageable risk. Every dollar you prepay on a 3% mortgage is a dollar you are lending to your mortgage company at 3% when they could instead be working for you at 4.5% to 8%. I say this clearly because I know people who locked in 2.5% 30-year mortgages and are now diligently prepaying them. They are leaving real money on the table. Here is the summary. The 60% LTV rule is not a rule you follow blindly. It is a framework. Above 80% with PMI, attack the balance. PMI elimination has among the best guaranteed returns available to a homeowner. Between 60 and 80%, personal decision. Factor in your rate, risk tolerance, and retirement timeline. Below 60%, the mathematical case for redirecting surplus cash to investments is strongest. At 3 to 5% rates, it is nearly unambiguous. At 6 to 7%, it is a close call. Above 7%, paydown becomes more competitive again. And critically, know your number, know your LTV, know what zone you are in. Most people do not. Jerome has transitioned from horizontal floor living to vertical alert position. Something is happening in the backyard. Jerome's priorities have shifted. My tie is still tight. And the mortgage balance is going in the right direction. But the dividend portfolio is going in a better one. Let the money do the work. In the comments, what is your approximate LTV right now? And are you making extra principal payments? I want to know how many people are in each zone. No dollar amounts required. I reply to every comment. Donald Cash. Out.